Hey everyone, Michael Beresford here, and welcome to our latest conversation on property market insights with the OpenCorp Group CEO, Matt Lewison. Matt, thanks for joining us.
Always good, boys.
Excellent. Well, what better topic to talk about than interest rates right now? So we've just seen a fourth month of consecutive increases on interest rates. Everyone's wondering what's the impact going to be on property prices? What does it mean for investors? Should I still be investing now, or is it time to be waiting? We've obviously seen all of this before. What would you say to investors about the opportunities right now?
Yeah, I think interest rates rising always gets a lot of media attention. It's spooky to the market, and especially seeing 4 consecutive interest rate rises, and that's obviously the first time that's happened for quite a while. But I think it's really important that people understand the history of interest rates to understand, I guess, what that means for direction of the property market, where interest rates might end as well. And we're not all economists, so we do take a lot of what we read for granted. But key thing for me is always coming back to, why are interest rates rising? What does it mean when interest rates rise, and how will that flow through to property and the things that matter to me as a property investor? The things that matter to me are my rental income, first and foremost, knowing that I'm going to have a tenant in there all of the time, my job, so security of employment. They're the biggest ones. I actually don't stress about price, and this is something I learned really early in my investing career. I bought my first property in 1998 when there'd been the economy had started to obviously soften a little bit. Melbourne's housing market had actually had a negative quarter of growth in 1998, and that was when I got into the market with my brother. I learned very early, and had been listening to my dad for the previous 5 years while I was saving, who'd said the best time to invest is as soon as you can afford to. And I could afford to in 1998 when I pulled my money with Al and we got into the market. It was nerve-wracking, having just seen a reduction in the median house price in Melbourne. It was the best thing that I ever did. And what I learned from that and over the ensuing years was not to pay too much attention to property prices, that if I could afford to buy and I knew that there was obviously strong income, then that was the best time to get in. And I appreciate that it's not always as easy as it sounds because of all the noise, and it's probably amplified 10 times in the last 24 years in terms of the amount of content and volume of it that we see. I obviously love your view on that as well.
Yeah, look, I was pretty similar. I bought the very first property I bought was in 2001. I didn't. That was an ex-principal place of residence. I didn't have it that long. I got into investing in 2003. So it was kind of around about the same time. And I thought that'd actually be a really good point to reflect on during this conversation, because let's be honest, interest rates go up and down. It's very easy to remember what happened yesterday and speculate about what might happen tomorrow. But it's definitely not the first time that interest rates have gone up. And specifically, if we take out the last couple of years in the COVID environment and record low interest rates, if you said that the cash rate could be around about 2%, I don't know too many people that wouldn't take that. So it's important to keep some perspective on these things. And while 4 consecutive months of rate rises might seem like a really big deal, historically, money is still cheap. But fundamentally, it just comes down to cash flow, right? Because smart investors are looking to hold their properties long term. They're not looking, or they shouldn't be looking, to make money in the first 2 weeks or the first month. So it's all about how do you hold these assets for the long term, and cash flow obviously is really key, as you said. So what I thought we could maybe delve into was around about that time that we both got started, around the 2000s, when we saw a jobs boom, we saw resources boom, we saw population growth. A lot of the same kind of economic variables and factors that are happening today. You learnt a couple of really good lessons in that time. One was the benefit of getting in when you can. And I might share my experience around that after you've given us your insights. But you also learned an equally important lesson painful at the time, but really powerful in terms of your overall experience and understanding of how property markets work, which I was hoping you could share with everyone as well.
Yeah, I mean, I think like anybody, early in my investing career, I perhaps didn't have the confidence of my own views as much as I do now. And I saw, and I was investing through the early 2000s and into the mid 2000s. In fact, in 2004 and 2005, and as a property developer who was also selling land in housing estates, you almost couldn't give them away at that point in time. I was still buying at that point in time, and I am very glad that I did. But it was in 2007, 2008 when interest rates had been starting to really ratchet up. And to put it in perspective, they'd gone from about 4.5% when I started borrowing to 9.5%. And I wasn't sure where they were going to end up, and decided to deleverage and sold an asset at what I thought was going to be I guess the best time. I thought, well, I'll shore up my cash flow. I'll sell this asset. I don't know where interest rates will get to. And it was actually about 6 to 9 months later, interest rates were actually on their way down. I sold that property for $350,000, I think it was, and today that would be worth $850,000. So I gave up $500,000 worth of capital growth and positive income that I would have had had I been able or willing to kind of see through the media noise. And I think that's why I'm really passionate about making sure that, first of all, I know what's going on with interest rates, what's driving the interest rates up, and secondly, why, if I'm cash flow positive or I can afford to hold, why I don't rush for the exits or stop buying or feel like I need to sell. It's really important. And again, I know not everybody has access to the data that we have access to, or the time, and it's not their job to spend hours of each day looking through all that sort of stuff. I made it my job because I knew how important it was after making that one mistake. But yeah, I think there's similarities in what we're seeing right now to that period of time, 2006 to 2008. And if I could go back to 2007, 2008, would I invest again? I absolutely would invest again. And what I've really learned about interest rates through that time, one of them is that interest rate is largely, at least what we're seeing at the moment, is being driven by constrained supply and supply pressure. And we know that looking at the supply pressure index, it actually peaked earlier this year and has been trending down for the last 6 months, or 5 to 6 months. And we're seeing inflationary pressure on a lot of the things like timber, on shipping costs, on oil, maybe not so much at the Bowser because all the petrol stations are having a lend at times. But certainly internationally, oil prices have come down. We're seeing a lot of those indicators looking a lot more favorable right now. And so we're seeing interest rates going up, and we're seeing the inflation measure going up, but things that are driving inflation are coming down. So essentially, the central banks of the world are ensuring that they get on top of inflation by ensuring that they dampen demand until they see that taper a little bit, and then they're obviously going to take their foot off the pedal. And we've even heard that from the US in the last couple of weeks, saying that they think that they're now at neutral, and they're in terms of interest rates, and any further tightening will be less aggressive than it was over the last few months. So again, it's really important to understand all of those things and not get spooked into what we've seen in the last 3 or 4 months and go, well, that who knows where we'll be in 6 months' time. I think you were investing, as you said, around that same time. Were you seeing similar things? We weren't comparing notes back then.
No, we weren't. At least not on property, maybe on footy. But look, I learnt a couple of really key lessons around cash flow and growth, and in investing, and specifically markets to invest in early on in my journey. I probably didn't realize how important they would be, until later on in my journey with the benefit of hindsight. But as I said, that first property I bought in 2001, while I didn't have it for a long time, I did have it during the boom that Melbourne had between 1999 and 2003. So even after that property was sold, netted out a good chunk of money, paid down bad debt, so to speak, like the car loan, had a deposit, or saved really hard to top up the cash with the deposit that I needed, and bought my first investment property in late 2003. Now, you might be thinking, well, hang on, Melbourne grew between 99 and 2003. Why was that a good move? It was a good move because I didn't invest in Melbourne. I wasn't investing where I had lived and where I'd grown up, but had followed the advice of some advisors and mentors, and they recommended that Perth made sense for a whole lot of reasons. The number one that I remember most was affordability, because I bought a 600 square metre block, a 4-bedroom, 2-bathroom, double lock-up garage house, in the suburban ring, middle ring in Perth for $267,000. So we can kind of laugh about it now, 20 years ago, but that property by late 2007 had grown to 485 on a bank valuation. So I think that the key lesson that I learned around that, or the two key lessons I learned around that, number one was you don't have to invest where you live, because there are always markets that make sense to invest in. They might not be, in your backyard. So take the blinkers off and broaden your viewpoint. And the second thing that I learned is, when markets move, they move quickly. And by being in the market, even though the interest rates were going up, I bought again in 2005, 2007, and 2008. And the only way I was able to do that, single income, albeit, good kind of professional job, was because the rents were keeping pace with the growth based on the supply and demand dynamics that were causing interest rates to go up in the first place. Because I learned that interest rates don't just go up because they go up in response to a range of other factors, which you've touched on already. So I think it's really important for people to remember that, your experience as an owner-occupier, where you're covering all of the holding costs out of your pocket, as opposed to smart investment, where all, if not nearly all, of the holding costs can be paid for by the tenant and the government via tax benefits. It's a very different dynamic, and you're not investing or you shouldn't be investing in properties that you love. You should be investing in properties to give you a financial return and allow you to be able to repeat that process. So, yeah, to your point, you kind of asked the question I was going to ask you: if, with the benefit of hindsight, would you have bought 20 years ago? I ask a lot of people that question. I'm yet to hear someone that says no. But it's the understanding of those cycles and understanding what's required to be successful is really the key part.
100%. And I think I took it for granted when I started. You touched on it just then, about affordability. And it's something we flagged actually at the start of this year before any interest rate rises took place. And we said that Australia is going to move into a 2-speed property market. And by that, we meant that the expensive properties, we're going to find it really hard, particularly for investors. And at the affordable end of the market, where there was scarcity, we still have incredibly low vacancy rates, upwards pressure on prices from the bottom. And what I learned from my dad, who was investing in pretty basic properties at that time through the 90s, and I wondered why he wasn't building the Shangri-La, and he was a builder as well. So why wasn't he making them look more beautiful? And I remember he said to me that the affordable end of the market, there was always going to be demand. There's always someone who can afford to pay the rent and who wants to be able to rent that property. And so that obviously became part of our strategy and approach, and it's never been proven wrong. Because even right now, we're seeing that huge demand at the affordable end. In fact, there's, I'm sure if anybody opens the paper and looks to the section of the paper, it's normally near the front, where they start talking about the families who are living in caravan parks because they can't find a rental property in Brisbane or in Perth, for that matter. Parts of other cities as well are incredibly tight. In fact, Australia's vacancy rate has never been this low. in my investing career. And what does that mean? That means that rents are actually being pushed up. It means that gross incomes are improving. So even while interest rate costs are going up, the income that we're generating from properties are improving. And obviously when we start to look through past this very, very short-term interest rate tightening cycle, and again, history shows they're reasonably short-term with the exception of kind of the 70s and 80s, but I'll touch on those separately. But this tightening cycle is going to pass. Obviously, all of the economists are now looking at it peaking pretty much by the end of this year and potentially even starting to see some easing in interest rates next year. But what does that mean? It means that the Australian property market then, if you just look back to the fundamentals of very, very low vacancy rates, very little supply coming through. In fact, there's less supply coming through now than there was even a year ago. We're actually seeing huge immigration push. I read this morning that June was a record for visa applications for people to move into Australia. It's the highest it's ever been in a single month. I think it was something like 45,000 applications were processed in June. If you annualize that, you're looking at over 500,000. So again, just think tight market with more people moving into it, puts upwards pressure on rents, means that there's always going to be a tenant in the property. And the next thing I love, and I've learned over time, is about the psychology of the market. It's hard to imagine, I guess, that the market has its own psychology, but what I've learned is that when rents are going up, and I learned this as a tenant, and I learned it as a friend of tenants, and I've learned it as a landlord, and obviously a student of property, that when there's upwards pressure on rents at the affordable end of the market, it makes it really, really stressful for tenants. Obviously, seeing that my rent's just gone from $500 a week to $550 or $575, and we're actually seeing 10-15% increases regularly. So when my rent's going up 15%, $75 a week, I start to get really stressed and go, what about next year? Am I even going to be able to afford this property next year? Will I have to find somewhere else? And if I go out there and there's a queue of people trying to get in, what does that mean for me? And that's when we see that real push at the bottom, those tenants trying to get out of the market. They're trying to get out of the rental market, they're trying to get into the homeowners market. And they're getting into the homeowners market in that sub $800,000 price bracket. And they're trying to use every government incentive that they can get their hands on, and there's quite a lot at the moment, to support them. And they're getting their parents who are seeing the stress that they're under dealing with this rising rents. Their parents are contributing. We're seeing that in record numbers as well, to help them get into the market as first-time buyers. And that really puts upwards pressure on prices as well. So we see the rents rising, then we see the prices rising at the affordable end. And as you know, guys, you kind of have to take the median house price with a grain of salt, because when interest rates go up and all the people in Vaucluse in Sydney and Toorak in Melbourne and Brighton and Hamilton and all Peppermint Grove in Perth, they all stop transacting their properties. Fewer properties in that premium end are selling. There are fewer being marketed, fewer are selling, which means the number of transactions in the market are diminishing, and they're favouring the affordable end of the market. And that's why we see the median house price dropping. Makes complete sense from the market psychology perspective as well. We also see it bounce back really quickly when obviously those parts of the market start to become more active again. And it doesn't mean that instantly prices are going up. It means that more transactions are happening there as well. But we've seen it in the last 5 property cycles in the last 24 years, that the affordable end of the market defies gravity, if you want to use that term. When there is an interest rate tightening cycle, we continue to see that growth and the rising rents. And it's exactly what we're seeing now. And again, to be able to look through, understand that, and see, well, what does that mean for me right now as someone who might have investment properties or might be looking to invest? And I know you've got a really clear message on that one too.
Yeah, I do. Look, at the end of the day, Warren Buffett's made a lot of money over a lot of years. Probably one of the most successful investors in history, definitely of our time. Be greedy when people are fearful, and fearful when people are greedy. So just remember, as we've talked about today, that there's not one Australian property market. There are markets within markets. And just because the paper says prices are crashing, you need to understand what that means. It means that the median house price is going backwards, but that doesn't mean that every house has lost that decrease in value. Recent example, you mentioned Toorak. Toorak is down 14% since the interest rates started to rise, 3 months ago or so. Affordable suburbs in Melbourne, where we've got a number of clients, have actually increased over 2.5% in that time frame. So that's, again, annualize it, that's growth of about 10% per annum. One market's coming back 14% a quarter. Another market in the same capital city, or a different type of property in the same capital city, is going up equivalent of 10% a year. So we hope that's helped you, cut through some of the headlines in the news, understand the fundamentals, buy safely and securely at the affordable price point. Hope you found that valuable. Matt, anything to add before we wrap and help people understand where we can give them some perspective on their situation?
Look, one takeaway that I've learned as well over the years is that if interest rates have gone up and what you can afford to buy has gone down, like your affordability threshold is reduced, buy what you can afford. Don't wait until you can afford that other property you thought was going to be the right property for you as an investor. And I separate that from owner-occupiers who have kind of different needs. But as an investor, if you thought 3 months ago you can afford a $750,000 property and today you can get a $670,000 property, don't wait until you can get that $750,000 property. Because if you do, you'll actually end up paying $850 for that one, and you'll have missed $100,000 of growth. And the one you could have bought at $650 will be $750, and you would have picked up $100,000 of growth there. So don't wait until the market's moved up to get in if you can afford something. And as you said, there's some great locations and great markets around Australia that are still on the up, with strong trajectory, low vacancy rates, rising incomes, and great prospects for continued growth. So if you miss that, then you set yourself behind a year, 2 years, 3 years in your journey.
Wonderful, Louis. Well, great to talk to you as always. Thanks everyone for tuning in. We'll look forward to being back in touch next week with another update. But until then, if you're keen to understand what might be possible for you, or you haven't even looked at what might be possible for you with the interest rate rises and what that means for your borrowing capacity, we can help. We're a full service property investment firm. Click on the link in the post below. Enter your details. Our team can be in touch, and we'll see if we can point you in the right direction. But until next week, thanks, Matt. We'll see you soon.
Thanks, Michael.